Welcome to MacroEdge Radio. Please note that the content aired on this program is intended strictly for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. The opinions, discussions, and views expressed by our contributors, guests, and associated MacroEdge staff are their own and do not necessarily represent the official stance, strategy, or opinions of the MacroEdge organization or any of its affiliates. While we strive to provide accurate and up-to-date information, MacroEdge Radio makes no representation or warranties of any kind expressed or implied about the completeness, accuracy, reliability, suitability, or availability of the content of this show. Any reliance you place on such information is therefore strictly at your own risk. We do not endorse or assume responsibility for the accuracy or reliability of any information offered by third-party websites linked through the show or any website or feature linked in any banner or other advertising. We will not be a party to or in any way be responsible for monitoring any transaction between you and any third-party providers of products or services. All audio content of MacroEdge Radio is the intellectual property of the MacroEdge organization, and any use, reproduction, or redistribution of this content without the express written consent of the MacroEdge organization is strictly prohibited. All rights reserved. Good afternoon, everyone, and welcome to MacroEdge Radio. This is John Galt speaking. Sorry for the delay, but for some reason, Twitter X is playing games once again. This afternoon on MacroEdge Radio number 17, we will be joined in about 10 to 15 minutes with Lance Lambert, real estate expert without question, someone who we have questions for because a lot of the programs you've heard, if you have not noticed, sound somewhat bearish in their questions. Granted, I do have that predisposition because I'm skeptical of society and the way this is being carried out. I'm going to be blunt about that. I've never hidden my biases. I think that the society as it's structured now and with the entire market on the edge, and I do mean a razor's edge, as we saw today, for any kind of news or information, it becomes a little bit dicey, folks. And it's got to get, I think it's going to expand out to real estate, to be quite honest. With all of that being said, today's market action, initially, I'm going to give it a quick scan, but initially wasn't as severe as we thought. In the bond market, it's a different story. But in the stock market, the rally monkey came out of retirement, came out of the bullpen, and made a last-minute appearance. We'll see how this turns out. Honest to God, I'm not sure what this means for the future. There are rumors that someone rather large had financial issues today and liquidated a lot of equities, and at some point decided they had to liquidate commodities. Well, guess what, folks? That is part of the ball game. We're going to see a lot more of this as we move forward. The entire economic situation changed with these data points today, and I will tell you quite frankly, what we witnessed is something that MacroEdge, and I'm talking about MacroEdge.net, heck yeah, I'm going to plug this because the MacroEdge team and John Johnson, the lead economist, nailed this, okay? Nailed the absolute, to the number, 4.3%. Now, I know I went out with my prediction earlier this morning, and I was pretty much dead nuts on. Let's just be honest about it. So when you start seeing these kind of numbers jump in rapid succession, it means that they've lost control of the markets. And they have got a problem, folks. They can't guarantee that they can stabilize this economy. Everyone's looking for the Fed for an answer. Everyone thinks the Federal Reserve has all of this magic that they're going to just suddenly impart and the markets are going to be fine. In reality, they lost control of this economy and this market almost 9 months ago, and it's just been deteriorating since. When I predicted early on that there should have been a cut in June and July, I was dead serious. I could see the deterioration way back in February and March, and it's accelerated. Odds are we're probably in month 3 or 4 of an existing recession when they do the look back from the NBA and say, yes, NBER, and say, yes, there was a recession. It started in April or May of this year, and it's going to go on. My fears now are that the Fed's inability to sit there and recognize what's happened will lead to a 9 to 15-month stagflationary recession where we will go through cycles of rapid inflation and no growth and rapid deflation in assets and negative growth or contraction of the economic situation. It is a scary time to be an American citizen because look at who we're depending on. An inept group of political leaders who can't get along on anything, who want to go to war, who want to sit there and raise taxes, cut taxes, but no firm economic model or plan has been set on. And everyone still thinks it's a speculative bubble. I'll give you some quick examples because our guest will be coming up soon. One of the things that I noted was that we heard on CNBC, of all places, Tom Lee makes his famous appearance. Well, the VIX got over 28, so that's a good indication that it's getting close to a time to buy. Now, the host, instead of saying, well, what if the VIX goes to 40, and challenging him, just let that go, because they're not there to sit there and sell economic reality. They're there to sell you a used car. And that car is a 1979 Yugo. It has 150,000 miles on it, may or may not have an engine, definitely doesn't have a clutch. That's why you have to be careful about what you are listening to, who you are listening to, and what is an acceptable level of pain you're willing to take. You have to protect your portfolio. No one on Wall Street is going to protect your portfolio. They won't protect each other's portfolio unless they have a counterparty risk. This is where the market becomes dangerous. This is where the economy becomes very dangerous. And this is where the impact of the layoff tracker that MacroEdge.net has been pushing and promoting and telling you there's more under the surface than you think is of dire importance for everybody to do it. Subscribe to MacroEdge.net, Ozone. Give it a 2-week free trial. Give it a shot, folks. You won't be disappointed in the data sets that are presented. I'm going to bring Six on real quick, get his initial market. At the end of this hour with Mr. Lambert, we're going to talk real quick about what happened in the markets today, the technical damage that was done, and we should have some better numbers as far as settling. Six, what's your initial take on what you saw today?
Well, we lost 54.32.5 last night on ES, and then pretty much just gone down since then. The unemployment numbers this morning, they scared people. They definitely scared people because, the 2-year futures were up 0.5% today, which is just an ungodly large move in that instrument. The markets are scared now. And I saw JP Morgan earlier said that they now think the Fed's going to cut 50 in September, 50 in November, 25 in December. That's a pretty stark change from what we saw. I don't even know if it was 2 whole months ago when Barron's put on the cover why he won't cut rates this year with a big picture of Powell. It's an extreme shift in sentiment in a very short period of time. And I know that people think that everyone's still in the buy the dip mode, and maybe there is a buy the dip opportunity here, but I wouldn't invest here. I would trade it here if that's what you think, but I still think we're going to go lower, maybe a lot lower.
My concern about this was the initial thing. We saw everybody pile into Apple today, which was an amazing play. We'll keep our conversations that are in our group off the air, but one of the things I noticed is for a stock which quote-unquote double beat, that was not an impressive rally of just 0.7% today. And
right. At one point it was up, 2.5. Yeah, what?
All I was going to say is, what I was going to say real quick is, this is where everybody seemed to pile their hopes on, huge volume, or was it just shorts covering and saying, I'm taking everything out and going home and just going to let it die on its own?
I'm not sure. I don't know what people are thinking buying Apple, but, it did sell pretty aggressively into the close, almost wiped out the gain. If we had another half hour of open market, I think it would have wiped out the gain altogether. I'm not sure. I think that's, that was just the safety trade of the day, as it seems.
And interestingly enough, the one safety trade we know about, gold, was up dramatically early and crashed and burned as somebody liquidated an extreme amount of contracts after the European close. That was interesting, in my opinion.
Yeah, today was pretty crazy. It does not look like just a normal selling day. It looks like people are pretty scared.
Well,
but not that scared.
No.
It wasn't down that much.
I actually heard a gentleman from one of the houses on the bubble vision. I just happened to have that on my Sirius today, God forbid. And he actually made the statement that this is a technical setup for another rally heading into the election. And I thought about this thinking, you're trying to lure people into a very dangerous market where economic conditions are deteriorating. And you are trying to hook them into buying your garbage so you can get out of your bad positions.
Yeah, I struggle with this daily. My clients that I have, I don't want to put them in stocks, but, some of it aligns with their long-term, plans. So I'm having trouble with that constantly.
All right, thanks, Six, for the quick update. I'm going to bring Lance on board. I see he's made it. Oh, he was here a minute ago. and now he's gone. Lance, you there?
Yep, I'm here.
Fantastic, sir. Welcome aboard, Mr. Lambert. For everybody who doesn't know, Lance has a fantastic website called Resi Club. I'd love to do a quick intro for everyone who's ever heard him before or read his material. Please tell everybody from MacroEdge what you do, about your website, and how to get access to it, sir.
Yeah, so I'm a longtime financial journalist. I've worked at places like Bloomberg and Fortune, and I spent a period of my career when I decided, you know what, I'm kind of tired of writing a bunch of stories. I want to lean into my analytical skills, and I wanted to become a data scientist. But I didn't want to pay for graduate school. I just I didn't want to waste the money on that. And so I did what I considered like a bridge job, essentially. And I went to work at Realtor.com after working at Bloomberg for a while. And I was a data journalist there, analyzing their data. But really I was working like probably 80, 90 hours a week because I was doing my day job and then also trying to, learn all these data skills, learn Python, get better at my analysis. And I was doing most of the analysis on listing data at Realtor.com. And at some point I was like, you know what? I am spending way too much time in the data. That's just not what I want to do. And so I decided that I kind of wanted to pivot back and be more of a data storyteller where I was spending time with the data, but then also writing stories, making charts. And so I went to work at Fortune and I was building a newsletter there for Fortune 1000 executives, people who want to get into the C-suite, a data newsletter. And when I was there, March 2020 rolls around, lockdowns, everything, and then housing gets crazy. And so there was a real demand to just kind of like understand what was going on in the market. People wanted a deeper amount of analysis. People didn't want just info from NAR. They wanted regional data. They wanted some independent looks at the market. And so I kind of got sucked into that, and people, responded positively to the content, and I just kept digging in. And, the mortgage rate shock came, and then people got even more interested. And so I just continued to follow the market. And at some point I was just like, you know what? I'm having a lot of fun doing this. I think I want to continue to do it. And so I left Fortune to build my own thing, Resi Club. And essentially it's a data newsletter where I'm just all the time relentlessly tracking the U.S. housing market, looking at mortgage, looking at home builders, looking at, what's going on across the country for days on market, what's happening for inventory, prices, and also kind of using, just the fact that I can get some of these executives on the phone, and try to get some access and ask questions and figure out what people think. And I also approach it as less of an analyst. Maybe there's a little bit of that, but it's also very much as like an independent journalist. So I'm just very honest with readers that I don't exactly know where everything is going to go with the housing market, where everything is going to go with home prices. I can't wave a magic wand and tell you where mortgage rates are going to be in 6 months. But I can do a lot of digging and I can ask a lot of questions and get a lot of other forecasts and a lot of other thinking. So I do a lot of aggregation as well to like get a lot of the home price forecast, get a lot of the mortgage rate forecast, although I'd say take a lot of those with a grain of salt as well. So that's like a long-winded response, but that's kind of my perspective and how I approach looking at the housing market.
Fantastic. And folks, for those who don't know, boy, that was a strange echo from the Exit thing. We tend to try to have everybody on to get every opinion as where housing is going, because the main part of the economy beside the consumer is housing, and housing is part of the consumer construct. Lance, I got some questions for him. I got 2 questions. I always try to have some good questions for my guests, and then we're going to bring some of the other MacroEdge team to ask you some questions also. First thing I'm going to bring up, because this really is something that hits my area. I live in Southwest Florida, for your information. And you know all about our market, what a crazy, insane area it has been from Manatee County down to Collier County. The trend in Florida affordability with property taxes, be they homestead or what investors are paying, plus insurance, do you see a reversal on that? We're starting to see a reversal in insurance thanks to some new laws that have passed, but do you see a potential change as far as affordability in the near future?
Well, what we are seeing in the Florida market is that we saw, of course, the huge run-up in inventory, which started initially in Southwest Florida, but it's really pushed into a lot of other places in Florida. But what we are seeing in the data for condo prices in particular is that they're falling in almost every market in Florida. The 27 markets that I track for condo prices, I believe it's like 24 are down year to date. And that was all year to date throughout the seasonally strong period. So I think there's very much downward pressure on condo prices. The Zillow data doesn't necessarily show huge drops for condo prices, but it shows drops. Now with single family prices right now, you have seen actives move up a lot, but on the prices, it's kind of a little bit all over the place for single family in Florida, where you will see in like the Punta Gorda data and like certain zip codes in like Cape Coral and that Southwest Florida area, more price give up and softening. But you're not necessarily seeing, at least in the data that I'm looking at, like big drops for single family. So I think when you look at the market, the weakest area of the market for Florida is definitely condo, and then it's existing homes after it. But the most resilient so far has been home building, at least from some of the data that I've seen from Parcel Labs there. Now, one theory that Allie Wolf has over at Zonda, and I have no way to verify this, but she seems to know her stuff, is her case is that the insurance premiums have not went up as much for new construction as existing. And you guys know better about, I'm looking through here. We have Melody, we have Trisha, some of the people on the ground more for Florida. But that's her case, is that the new construction has been buffered a little more. And then also these builders are not necessarily putting up the product, which is these older existing condos that are getting affected more. And so Parcel Labs just did a recent analysis, and I was looking through the raw data. But if you look for condo prices, it's actually weaker for every decade you go back in terms of when the product was built. So right now, product that was built in the 2010s is weaker than the newest product for condo. Product built in the 2000s, weaker than the 2010s. 1990s, weaker than the 2000s. 80s, weaker than the 90s in terms of the condo softening there. So in terms of like where it's going, I can't necessarily say that, but if you look at the actives, given the run up that we've had and the fact that a lot of these markets didn't see appreciation there, it's definitely, you're still in the phase where you're seeing the softening and seeing the cooling in the data.
I could probably add some insight to that. We're seeing a lot more of this in Southwest Florida, especially on the coastlines and in a lot of the communities like Venice, Florida, where there's a large elderly population on fixed incomes. What most people don't understand, if you live in a condominium, you're not only paying your own insurance, but you're also paying an HOA fee. And part of the HOA fee, folks, is insurance on the roofs for the condominiums for hurricane damages. And the rates for the associations have skyrocketed, obviously with Irma and Ian passing through in the last 6 years, and also with the number of people moving into the state driving the prices of the condominiums up. That has also had an impact on our markets. So, Lance, that might be part of your answer. I think what we're seeing now is that the people are being forced into sales because they can't afford to stay there anymore. And if you're 85 years old, what are you going to do? You're going to take whatever price you can get and bail out of the property.
Yeah, and the other thing, I think another reason that has helped to accelerate the weakening in Southwest Florida versus some of the other places, of course, the weakening was accelerated by the hurricane, but the other factor is the migration levels have rolled over quicker in some pockets of Southwest Florida relative to some of the other places in Florida. And so I think that's a significant factor as well, is, you have this huge historic run-up for prices, and then once some of that new demand coming into the market has pulled back, that's when it's a little bit more of a struggle on the market to support those strained fundamentals.
And the only reason I bring this up, folks, is that Florida and Texas are the two largest in-migration states. They also have a tremendous impact on national average prices. I'm going to ask the next question here and dig into this. The challenge for existing home buyers, I'm talking about the individuals or the mom-and-pop investors who might have a rental property or property that they've owned in another location. They're being challenged by larger investors, and everyone's going to throw Blackstone out 99.9% of the time, but those larger investors can afford, as we've seen in Florida and in Texas, 25 to 40% losses on a property to get out of it, but the impact on the neighborhood is somewhat substantial because it's dragging the valuations of those properties down. Have you seen impacts on prices? Is it regional, like Florida, Texas, et cetera, or is it starting to spread out nationwide with those kind of liquidations from investors?
Well, so I think with the institutional buyers, I think there's a few things. The first thing is obviously during the pandemic housing boom, during the period of ultra low rates, where a lot of properties cash flow, rents are running, prices are running, there was an increase in the amount of scatter site buying that the institutions were doing. According to the John Burns research and consulting data, they got up to like being 2.4% of transactions in Q2 2022. That, of course, is decelerated way down. And the most recent quarters, it's around 0.4% of resale transactions being these institutional buyers with more than 1,000 homes in their portfolio. So we've seen a big deceleration in the buying. And it's very much, all of their presence is very concentrated into, a few markets throughout the Sun Belt. Dallas, Charlotte, Atlanta, Phoenix, Tampa, and I don't know if I already said Dallas, but those 6 make up 35% of all institutionally owned homes. But in terms of the selling, I mean, you are seeing some of them sell, right? Like Vinebrook, or you'll see, one of them sell in a certain area, a bulk of homes. But you're not seeing like a huge, massive sell-off where it becomes, a big number amount in the aggregate housing market or even in metropolitan areas. I think on a zip code level, you could see some places, the Vinebrook sales that occurred at the end of last year, you got it to where they ended up being like 25% of the listings in a few zip codes in like Milwaukee and in Cincinnati. So I think you could have an impact there. But big picture, I don't think it's having like a huge impact. I think the number one thing is that it signals to you that the fact that you're not seeing a lot of the institutions buying a lot of homes, I think that signals that the cap rates aren't in a place that's enticing them. Home prices have went up a lot. Rent growth is kind of at least decelerated a bit. And then another thing that doesn't get talked about as much that the institutions bring up to me when I talk to them is that their cost of repairs and the cost of maintenance, they've gone up a lot, right? So the returns aren't as great. Where we are seeing them still lean into is build to rent. And there was a bit of a pullback there, but now there's still more capital going into that market and interested in going into that market. And so take AMH. I talked to their head of their build to rent unit a few weeks ago and just published the story on Resi Club. They have about 59,000 single family homes. 10,000 of those now are from their home building unit. And so their home building unit is now the 39th largest home builder in the U.S. And they have another 10,000 homes in their pipeline for build to rent. And so if you go back to 2022, Q1, 33% of their acquisitions were from their build to rent unit. Q1 of 2023 and Q1 of 2024, 96% of all their acquisitions were build to rent. And so they are almost doing no scatter buying, AMH, which is American Homes for Rent. And they're not really buying directly from builders. It's just their build to rent. And so I think you're going to continue to see build to rent activity. The sell-offs that come from the scatter sites, I think, are going to be more isolated within the institutions and driven for very specific reasons. It could be liquidity reasons, like where you had Starwood at the end of 2022 or end of 2023 sell that 1,800 home portfolio to Invitation Homes. I think it's more like that, which of course Starwood, they have liquidity problems from their commercial side. So I don't know if that exactly answered the question, but that's like my long-winded look at the institutional side of the market at the moment.
That was actually fantastic. That's what we were looking for, because this is one of those questions that everyone sees headlines but doesn't understand the underlying causes and creations of what's going on. And I tend to think it is, like yourself, regionalized to certain markets, neighborhoods, et cetera, which brings up the next question. Because the home builders have done a pretty good job, does the return of the MBA Purchase Index back to February 1995 levels concern your future outlook, or have the home builders finally learned how to manage land and spec inventory to match actual demand, the actual demand that can afford the homes they're building?
So that's a great question. And what we have seen on the existing side of the market is that affordability is just a huge issue, right? It's a big issue for buyers. It's a big issue for sellers. I mean, there's a lot of people in the country that would love to sell their home and buy something else. But not only do they not want to stomach losing the rate, they can't even afford to do it at today's rates and today's prices. And so the existing side of the market, we've seen that pull back. You know, we did start to see resale new listings come up a bit this year, but really the churn in the resale market is still very suppressed. There's not a ton of churn in the resale side of the market. And then that increase that we got for new listings this year, which wasn't a lot, it wasn't really getting absorbed into the market, right? Buyers there's still the constraint there. And so that's where you're starting to see that cooling, where active listings are slowly building, months of supply are slowly building on a nationally aggregated basis. But when you talk to the big builders, and I just talked to KB Home CEO, you would actually be surprised how different the conversations go on the mortgage side versus these big builders. I mean, KB Home CEO, I'll be blunt, you know, he still has like a swagger, like he's still optimistic about this market. You know, he's bragging about the fact that on the new home community, their rate is 5.5 homes for average sale per month in this most recent quarter, which is near one of the highest they've had. And you look at their net new orders, they're still fairly high. Their gross margins are actually above 2019 levels. And when I talked to KB Home CEO, Jeff, last year, he was telling me about a few markets like Denver that they were in correction, right? Because they're for them, price cuts aren't only because of higher months of supply. That's a big part. The other part is if they get too out of whack with their premiums, so the difference between new home construction in the market and then resale prices. And so in Denver, the new home prices got too far out of whack with the existing side of the market. And so they were doing outright price cuts. And KB Homes isn't as much into the mortgage rate buy downs. They only spend about 2% of revenue on buy downs and mortgage concessions. They're more on just outright price cuts. So if they have to do a correction, they'll just rip off the Band-Aid and cut price, which is an outlier among the publicly traded builders. And so they were still in correction last year in Denver. But now he had said that, you know, they've pretty much met the market and aren't in correction in any of their major markets. Now they are keeping an eye on Florida. You know, they even noted on the earnings call that Florida is an area that they're watching. The amount that months of supply has moved up, they had suggested, although they haven't seen it yet, that there probably will come a slowdown in sales in Florida. And so, you know, his narrative is kind of the fact that he believes that the market is, you know, he thinks it's underbuilt from the GFC bust, and the fact that following the GFC bust, there wasn't a ton of the single family homes, especially in the lower half of the market. And so their average price is around I think it's like 380, 390, 400. And so where they build and who would be buying this product, there's just not enough single-family homes, at least for sale, in the market, is his argument.
Well, he has every reason to be optimistic. The name of his company is not Lennar. Moving on, because I read your interview with him. It was fantastic, by the way, and he did hit it. In my opinion, he was doing it the correct way. He was attacking it from price versus buy downs, which I think are going to have consequences for some of the public home builders. Another time for another show. From one of your articles, I'm going to extract from your articles. And by the way, the name of his website, Lance's website, is ResiClubAnalytics.com. That's RESI Clubanalytics.com. We plug our guests. we encourage them to plug their websites and their services.
I appreciate that.
Well, that's what we're here for. We're a team. Everybody here believes in getting out as much economic data and information from different perspectives across the spectrum. I'm sure there are some people that will never want to talk to me. It's just my habit, and I come across as a little bit sandpaper to some people. But we want this information out for the public and let people make investing and economic analysis decisions based on this information. And Lance, that's why I like your website. You bring everybody in. You don't take any kind of bearish or super bullish approach. You just say, here's the data. Look for it for yourself. Going off of that, you're talking about the return of inventories to pre-pandemic levels in Florida, Idaho, Tennessee, and Texas. Now, folks, those are all four of the hottest markets. We know about Florida and Texas. Idaho is the California relocation, like Arizona was and Nevada was. Tennessee is what we call the halfway point. We call them half-birds down here in Florida. People live in Florida and migrate to Tennessee during the summer because it gets a little warm and windy down here. Is this a more accurate representation on the affordability or that's causing inventory to pile up or begin to accumulate back to normal levels? Or is it a bullish sign that the management of the inventory is getting more efficient in the market from builders and existing home sellers alike?
I think the first thing is to point out just how unhealthy the market got during the pandemic housing boom. And so the Federal Reserve estimates that, and this is a paper they did at the end of 2022, that housing demand increased so much during the pandemic housing boom that new construction, in terms of like housing starts, would have needed to increase 300% to match that increase in demand. That's obviously not possible. You can't really increase construction like that. It's a slow moving. It's not as elastic as like the demand. And so we overheated, and the market overheated, and you see that in the active inventory data, which is, it's kind of like your equilibrium between supply and demand. It's a lot of like a demand metric, months of supply and active inventory. And so we saw that just really just plummet and free fall as we overheated during the pandemic housing boom. And as we've come out of that, there was an expectation that we would see it, rebound, right? As the market, affordability got strained by mortgage rates going up, that would kind of temper the market and we would see it moving. We are starting to see that now, and we've slowly been seeing that since June 2022, but it hasn't happened as fast as expected. It's kind of taken time, and the markets that have gotten there, like the Floridas, parts of Florida, parts of Texas, Arizona's getting close, Utah's getting close, Colorado's getting close, Idaho's getting close. Some of those markets, there was, a lot of outside demand that came in during the pandemic, and so price growth was a little more elevated there. And as we saw that temper, and as we saw that roll over, and a lot of wealthy people from San Francisco, Seattle, and Los Angeles, fewer of them started to move into the places like Boise and Austin and Colorado Springs, and rates went up a lot. We saw that the locals in the market, because it was more strained, there was less of that, fewer people transacting at where prices got to, right? And so as homes sat on the market longer and took longer to sell, we saw actives build. The other thing about those markets, now I think there's a lot of narrative that Austin's build up for actives is only because they have a lot of construction, and they do have a lot more construction than other markets of the country. But they've had that, right? So I think it's less because of the supply, and it's more because they just really overheated. Austin was up 40% year over year for prices at one point. But the fact they do have that new construction, that steady flow moving into the market, and builders, they're going to want to move that product. And so they do the affordability adjustments if needed. They have the buy downs. And so that the fact that they even have that inventory there, it attracts some of the buyers who might have otherwise looked at resale. And so that helps to, keep resale homes on the market longer and kind of build up the days on market. The markets that have been in more trouble from at least from a buyer's perspective right now are a lot of these Northeast and Midwest markets where they didn't have a huge run-in from outside demand into the market. They did, of course, overheat because everywhere overheated. There was an increase for demand in housing space everywhere in the country, even the places that lost San Francisco or lost population like San Francisco and New York. As, roommates decoupled, people wanted more space to work from home. So there was an increase in demand everywhere and an overheating in prices. But you didn't see that migration from other places coming into San Francisco, coming into New York, coming into, some of these other places. And so because they didn't have that influx of migration, well, they're not going to see a pullback in the migration, right? So that's one part. And the other part is you don't have that new construction supply going into the market. And so there isn't, that cooling effect that would happen on the resale side. So, if you're an existing homeowner and you're selling in some of these parts of Connecticut, New Jersey, Pennsylvania, Wisconsin, you just don't have as much competition from the builders who might have 4.5% mortgage rate buydowns, right? And so their supply-demand equilibrium hasn't healed as much. And this is kind of like my view, and, this can be debated and people can have other perspectives on it, but this is just kind of like my interpretation of the data. And the other thing is you're still seeing somewhat of a donut effect. So in like urban parts of like Philadelphia, Washington, D.C., and New York, while you will see me publish data about like those metros being stronger, some of the urban parts are actually still weaker. And actually I've seen prices fall from the peak. But what you're seeing in some of those markets are the deep, deep exurbs. So places that you would have never wanted to commute 5 days a week. But you know what? If you can no longer go fully to like Boise or Austin because your job still wants you to be kind of close, but you only have to come into the market like 1 day a week, maybe 2, that's something people will do a much further commute and buy further out. So what you see is an expansion on the ring of the housing markets, the metros, going deeper. And so this is true for Philadelphia. It's true for Boston. It's true for New York City, Washington, D.C. And it's very much true for Connecticut, which kind of falls into that for kind of Boston, kind of New York. And so the hottest markets of the country right now are these deep, deep exurbs in like Connecticut and New Jersey. And then the other one is Southern California stayed fairly tight as well. I view that market as, very underbuilt. And there's also been the huge run up in Western housing markets, not just for like 2 years, 3 years, 4 years, but really just since the end of the last bust, once it bottomed. And so that huge run up is just, and so over there, they briefly started to go into correction mode at the end of 2022 because the fact that there wasn't as much supply for a decade and the fact that home prices ran up so much there, they were just more vulnerable once rates spiked, where people were already stretching themselves so thin and there was already so few buyers who could transact at the prices that when rates moved up for a bit, they destabilized. But then they very quickly firmed up because there isn't a lot of new construction in Southern California. There's not a lot of supply. And so we've actually seen more resiliency for price growth in Southern California, as well as, those deep exurbs in the Northeast and pockets of the Midwest. And then the place that is surprisingly rebound this year, if you look at the data, is San Francisco and San Jose. Those were also markets that were kind of hit hard at the end of 2022 when rates moved up a lot. But I think a lot of that is the fact that those tech stocks have rebounded and the AI boom. I mean, you look at NVIDIA stock and, the number of AI, even just little small AI companies you've never heard of that have just completely ripped over the past, 12, 18 months, I think has been a nice injection for those Bay Area markets.
Hey, Lance, how you doing? I'm going to jump in here while John gets reconnected. Can you hear me okay?
Yep, I can hear you.
Excellent. Pleasure to talk to you again, and I hope that you're doing well. Doing a master class so far in this discussion, and we appreciate having you on. You had mentioned earlier, talking to Jeffrey Metzger and about KB Homes, and even about their gross margins. And you and I have discussed this a little bit, where I've seen some margin compressions, but I'm genuinely curious to get your thoughts on the conditions around home builders right now, home building in general. What are your thoughts on where those gross margins are and where they're going given the conditions in the market?
Well, so I think one point is, one thing that kind of throws a wrench in the narrative for the builders is the fact you are seeing the number of completed homes, unsold completed homes go up, right? So that's concerning, right? Although you're not necessarily seeing as much of a hit for, net new orders of these builders at least on the earnings reports right now. So I think that is an interesting paradox, right? Where we're getting some of this public data that is suggesting more softening for the builders, and the earnings reports, which have been fairly resilient, and that includes the net new orders, the gross margins, as well as the commentary that they're giving. I posed the question to Jeff, and his view, he and I don't know if I have no reason to believe this, because, or at least I'm not going to buy it right away because I don't have anything to back it up. But his view is that he doesn't really trust the census data, doesn't trust it for a lot of the figures. And he kind of went on a explanation about why, and the fact that so this huge run up in the number of housing units, or which ones are they? Are they the start? Which is the one that the total housing units under construction? That's the one. And so his view there is, some of this is because of how they do the survey data, and then some of it is the fact that what should be a start, or some things that shouldn't be considered starts are considered starts. So his argument is that some of these homes at the end of the year or some months, because of the rules that these municipalities have, builders will accelerate the reporting process just for tax reasons or other purposes, and that, the homes aren't as far into the pipeline as the census data suggests. So I don't know if that's true, but there is a paradox right now where the census data is showing a lot more weakening than softening for new construction for single family. And at least the builders' earnings reports, net new orders for the publicly traded aren't showing as much. And that paradox is confounding because these big publicly traded builders, they're now 50% of the market share. So if 50% of the market share is publicly reported, and I can aggregate this up for, these 20, 25 big builders, and it looks so different than the public data, that's either one, maybe the public data is off, or two, and maybe this is more likely, is that these smaller builders are just really where the pain is. And I think that's very possible because even, Jeff was saying over at KB Homes that they're taking market share right now, right? Because these builders are struggling to get financing, and their rates are so high. And a lot of these smaller builders just don't have the capital like these deep-pocketed, publicly traded builders. So maybe that's a big part of it.
Great answer. On that, on the market
by the way, that is actually one of the toughest questions right now, and I don't have 100% answer to it, but there is that definitely a divergence there.
I would agree. I think a lot of everybody that we've talked to, in housing doing analysis has brought up some concern over the census data, and obviously it's been a topic as far as employment as well. So it's an interesting point. To your commentary about market share and publicly reported, you did a great analysis the other day and shared on X-Twitter here about the market share controlled by publicly traded builders. Given the conditions and what smaller builders are facing, do you see that being stable, or do you see it continuing to grow, that the larger builders are just going to continue to take over even more market share?
Yeah, so I think there's some secular reasons that it's going to continue to go, whether this rate hiking cycle happened or not. But the fact that we went through this rate hiking cycle actually accelerated a trend that was already there. So we were around 25% market share for publicly traded builders in terms of new home closings back in, I think it was 2006. That slowly got up to 38% by 2019. And then as of last year got to 50%. And Allie Wolf told me that she thinks it's going to 60% over the next year and a half, which, that's a huge jump to go from 38% in 2019 to, possibly up to 60% by, 2024, 2025.
That is a big jump, but I could definitely see that, especially given that we've seen some bankruptcies of small builders already that we track in-house here at MacroEdge, and just the conditions for small builders that maybe need to use more debt than some of the large builders are doing. Those are really, really challenging times right now for the smaller builders. To that point, do you see pricing changing much throughout the year for the new construction market, or do you think that the builders have reached their levels of incentive that they're comfortable with leaving pricing as is, and they're going to continue to use whatever the incentives, whether it's rate buy-downs or upgrades for some of the builders that do offer those? What are your thoughts on what you're seeing and what sentiments you're tracking?
Yeah, so KB Home CEO said that their barometer for new home prices is months of supply, right? Also the resale new home versus resale premium, but really it's the months of supply. And where a lot of the builders are at is, in the Sun Belt. And these are the places where months of supply has went up a lot. And so I think the second half of the year, given this run up that we've had in months of supply, I think a lot of the builders are not going to be getting too greedy on price. I don't think they're going to be trying to push prices more. I think it's probably, kind of hoping that, they don't have to cut prices, and more of just holding prices firm in a lot of these markets and trying to move product. And then where need be, and I think this is going to be pockets of Florida, they'll probably have to do affordability adjustments, even with the mortgage rate drop potentially. Zonda does a survey of home builders, and the April results showed, builders were still kind of selling at expectation despite the increase in inventory. And so I wrote a piece talking about the fact that, despite the big run-ups in, inventory in Florida and some price give up in the condo market in Southwest Florida, builders were still feeling good. And I based that off this Zonda survey of builders. Well, a few days after the story went out, Allie Wolf got the results for June, and it showed a big jump in the concern among these builders where they weren't meeting their expectations. And, I tweeted that out. And then the next month, the June numbers came in. And the June numbers showed that pretty much every single it was 100% of the builders responded, said that their sales were weaker than they expected for the month, and that around 40 or 50% were getting concerned. And so I think seeing that for, the shift for May or for April, May, June, and the fact that that is still kind of in the stronger seasonal period, which I don't know as much about the seasonal cycles for Florida, but I would guess that they're going to, be very cautious and probably have to do some discounting and affordability adjustments in the second half there.
Great thoughts. I don't want to hog up too much time, so I'm going to invite Melody to take over and ask a few questions.
Actually, I saw that Tricia just came up. I wanted to see if she wanted to go first, especially since Lance specifically talked about some of her market. If that's okay?
Of course. Welcome, Tricia.
Yeah, I'm just going to bring up a quick point since he mentioned it. What I'm at least seeing locally is, and sorry, I'm at the grocery store, but with the small builders, part of their problem is a lot of them have a lot of backlogged inventory. So they have all this inventory that they were building back when all the material costs and labor costs were tight. So they had a lot of carrying costs with extra interest in that. So from at least what I see here is I think that's part of the problem with the small builders. And now you've got the big production builders coming in, and they're producing and they're doing all the buy downs and all that. And so they have a big advantage over the small builders right now. So just wanted to throw that out there.
Agreed.
Yeah. And a lot of these big builders have, their own in-house mortgage companies as well, which is, it's kind of interesting where the market has gotten to, where a lot of these institutional buyers now have their own home builders, own home building unit division. And then a lot of the builders have their own mortgage arms. But I think that's definitely an advantage for the bigger builders over the smaller builders. They're just faster to meet the market.
I can go now, Mr. A, if you'd like me to.
Please do.
So, Lance, one thing I think that a lot of people aren't talking about is the speculation in the existing home market. So I think one of the things, so I absolutely understand, and I caught your interview with Travis, on sort of the reaction function of the new homes, that kind of thing, but I think that there's a lot of weakness in the existing home market that people haven't seen yet because there was simply so much second home buying where people, and this is something when we were down in Austin interviewing people, we heard all the time is people in their 30s bought these second homes to fix and flip, but then they were sitting on them because they couldn't afford the repairs. And so, when you look at some of these markets, how much are you thinking about the speculation in the existing home market?
Yeah, so one of the things I'm actually watching pretty closely is unemployment data for people who make more money and maybe have higher degrees, right? Because the thinking there is that, they might be the ones more likely to have bought in some of these second homes, right? And what we're seeing right now, if you look at the employment data, is that you haven't seen as much of a hit there as the lower earners. That's where it's kind of been concentrated in the unemployment data. Now, if you go around and talk to places, you'll hear a lot about how it's like harder to get some of these higher earning jobs. But in terms of the employment hit, it's been a little bit more resilient for that group relative to some other groups. And I think why that matters is because what you said, which is there was a lot of second home buying. There was a lot of short-term rentals. There was a lot of people buying these homes because, appreciation was ripping during the pandemic housing boom. Rates were so low that the payments made sense. But over time, we could maybe see more of these come into the market. But I think what would have to happen, I would think, and Melody, maybe if you have a different view of this, is that, I think their incomes would need to be affected, if we were going to see any type of movement there back into the market.
I'd say certainly, Lance, I think that is a great point. I think what a lot of people aren't thinking about, though, is the debt service costs of those people that are making over $100,000. And so I think Danielle DiMartino Booth did a great analysis on those quintiles, and the ones making about $150,000 to $200,000 are about 20%, and they are so debt burdened at this point. We just saw that, I think, CNN article about 39% of Americans are worried about paying their bills, which was 2% higher than, the GFC. So I agree with you. I think it is on the income side, but I also think that what's happening as these credit card interest rates are so high, buy now, pay later, all this excessive debt, I think could also start to push those homes to the market.
And on the short-term rental side, that one I think is a little bit different in terms of like what would put the pressure for some of those markets coming in, or some of those homes coming back into the market. And I think that one is already there because the fact that we have seen some correction in the short-term rental market, right? And we have seen, what are we at, like, I think we're at 16 straight months of year-over-year declines for short-term rental demand, according to AirDNA. And I've talked to a few agents across the country where they're not getting much business, right? There's not a lot of resale churn in the market, but there's a good chunk of what their business that they're doing that are short-term rentals that are coming back into the market. And so in terms of like what type of movement that has on a national basis, I don't think it's necessarily huge, but I definitely think it can have a big impact in zip codes in certain submarkets of the country.
Yeah, you're actually, I think, Lance, seeing it right now where the inventory, so I have a little bit different analysis. I look at 80 plus cities, but a lot of where the inventory is just crazy increasing are in these very specific short-term rentals, and also where sales continue to increase, whereas, we saw such abysmal results last month. So I definitely think that is a factor, but I think more importantly is that with the increases in property taxes, insurance, and home ownership costs, as well as the increase in, credit card interest rates, and additional debt, I think that even if folks don't lose their jobs, we could still see increases in inventory. However, should say, I think people are, obviously MacroEdge has an amazing layoff tracker. We're seeing it, the Intel announcement, people are losing their job, but I think even if they didn't, we would be looking at some serious affordability issues for existing homeowners, by June of next year.
And with that being said, I'm sorry, go ahead. Hi, Melody. I'm sorry, I didn't mean to interrupt you.
No,
go ahead,
I was going to say that was a statement, not a question, so back over to you guys.
Thank you so much, Lance. I've got a couple questions to throw this out here because these are the questions I didn't get to before X decided to deport me briefly. Will the slow rolling collapse of multifamily start to have an impact on single-family home sales as it puts more stress on the financing industry? In your opinion, this is an opinion question only, of course.
That's a tough one. And so let's just go over some of the facts that we know to be true, which is there was a lot of additional multifamily starts during the pandemic housing boom, right? There was a lot of finance projects, and and it made sense. Rates were so low. And so we've seen a lot of that, increase in 2023 and 2024 completions come into the market, right? And where it's happened in the biggest concentrations, pockets of Nashville, pockets of Phoenix, pockets of Austin, we have seen, multifamily rents come down a bit or, bigger incentives. Now, the big question is what happens after this, these completions from 2023, 2024. And there's a lot of speculation there where, some of the groups expect a bigger rollover in multifamily the next several years. Others don't expect as much. Now, I don't have a great answer in terms of what type of rollover it could be. Is it going to be a really big rollover? Will it be a mild one? I do know that I was talking to John Burns last week, and he's actually a little more optimistic now and seeing more capital come back in for apartments. And so I think that is something that's kind of interesting. But in terms of like what impact does the apartment side have on the single family side, it's tough to say. And maybe some of this increase that we've seen in actives over the past year, which is happening in some of the markets that does have more multifamily construction, right? So maybe it's playing a role. I don't necessarily know, but because the thing is the economics there of single family and multi are different, right? Where if you go back to the bust, multifamily rents were a lot more stable, right? Whereas if you look on the single family side, especially for home prices, well, they ate shit. So I think and you see this in housing today, where you can have such big divergence in so many different ways, where if you look at the mortgage market versus for the big publicly traded builders, or if you look at Austin and Punta Gorda versus, let's say, Hartford, Connecticut, or certain parts in New Jersey. So I'm a little cautious there to say what type of impact the multifamily completions will have on the single family market.
I look at it more from a securitization standpoint, and that's why I was bringing that question up, because I think that people get a little gun shy when housing as a whole, the nebulous housing group as a whole starts to get in trouble. They can't seem to isolate multifamily from single family from investment grade, et cetera, et cetera. And it does tend to sit there and clump everything unfairly into one group. My next question is, today was a very fascinating day, for lack of anything else, with the data finally becoming a little more honest. At what point do you think employment levels that we're seeing, and MacroEdge has been tracking this, I hope you've been following us. If not, talk to the man in charge. I'm sure he can hook you up. When do you think that the unemployment levels start to get critical for single-family housing?
Yeah, so what we're seeing right now is we are seeing the number of unemployed Americans on a year-over-year basis is up about 1.3 million on a year-over-year basis. And so if this were to continue at this rate and we were to continue to see labor force grow at the current rate, by this time next year, we'd be at 5%. Now, if there's any big fluctuation there where labor force were to decelerate, right, the growth of labor force, or let's say unemployment were to accelerate, you could very quickly get the math in a place, and I ran the numbers a few times, where you're a lot more than 5.5%. And so when I was saying 5, it's 5.0 would be where we would be this time next year if we stayed exactly on the trend. Well, if you look back at history, usually if you do get in a period where labor breaks, you kind of get through a very, slow build up, and then it happens very suddenly, right? And so I think if that were to happen, I think that would, it's going to have an impact on housing. It's a question of what type of impact will it have. Will it be, a brief impact, so that's just you're asking one of the toughest questions out there, because it's two-pronged. It's, do we actually have a big jump in unemployment and a recession? And then how does housing respond to that recession? And if you go back, one thing that is very true is if you go back every recession, how housing has reacted has been very different across a lot of these. And some sub-markets have gotten hit more than others, and some certain areas of housing. So one example being is that if you go back to 2009, mortgage, started to do good, and there was a refi boom, right? Whereas, for single-family home prices and single-family construction, it was still a couple years out before the bottom. And so I'm kind of, this is a question that I've been asking a lot, and Kevin is somebody I see down in somebody here who is in the audience that is somebody who I've asked a few times his thoughts. I've asked like Mark Zandy this, Logan Motoshami, some of these other groups like Goldman to get their view. And the views there do vary a lot. But, one unique thing about the cycle is that housing affordability is so strained. So there is a question of if we do go into recession, how does housing perform in an environment where the affordability is so unhealthy?
I appreciate that answer, because I'm in the same boat that you are. I look at this as more of a credit crisis approaching than a housing crisis. And yesterday, Calculated Risk Bill McBride, which you know more than I do, but I've been following him since the 06-07 era, which is where I got my feet wet into this. His inflation-adjusted housing prices were 1.9% below the 2022 peak. Do you think this is a whiff of deflation or a distortion due to the regional price declines in the Sun Belt? Oh, maybe we lost Lance.
Oh,
there we go. That's okay,
yeah,
man. That's just so swirly today. I accept it, sir. Thank you.
For nationally aggregated single-family home prices, on a nominal basis, they're up still a bit in terms of, over the past couple years. So for Case-Shiller, over the past 2 years, the past 24 months, we're up 5% over the past 24 months for single-family home prices, whereas the previous 24 months, which would be May 2020 to May 2022, it was up, close to 40%. So to go from 40% appreciation over a 24-month period to 5% over a 24-month period, it wasn't a big nominal correction nationally for nationally aggregated prices, but it was a deceleration in coming out of the overheated period for prices. And so on a real basis, yeah, some of these will show a little bit down from peak after you adjust for inflation. And a lot of that is driven from, that last, 6 months in 2022 where there was some outright nominal declines for a lot of these indices on a national basis. But for home prices, on a national basis, they haven't moved that much. And so go back to your question real quick. What was the question? I wanted to overview some of the data real fast.
Bill took an inflation-adjusted look at the national home prices for single-family homes, and he said that it's 1.9% below the peak. There's a slight decline. I'm wondering if this is a whiff of deflation or a disinflation, or if this is indeed a fact attributable to the price reductions we're seeing in major markets within the Sun Belt, which just truly does distort the data.
Yeah. So Bill's is for real for inflation adjusted. I read that piece, and so a part of this is disinflation, where we've come out of the overheated period for home prices, and then we decelerated significantly, and the Sun Belt markets and some of those parts of the Gulf and some of the parts of Mountain West have been, the leaders for that. And if not for those markets, we would, on a real basis, still be at all-time highs, especially because of the Northeast and Midwest.
I'm going to ask one real short question. Do you track any overseas data?
Not a lot.
That's what I thought.
I get some of the stuff from like Goldman Sachs or Morgan Stanley, but no, I don't. I'm U.S. U.S.
Okay.
And really U.S. for metros, and then U.S. for counties is my main focus.
Fantastic. Now I'm going to ask the question. I'm the guy who likes to test the compliance officers and make sure everybody's on their toes. So let me ask this question. This is an assumption question, and believe me, I'm totally apolitical. I hate both parties and everybody who's running for president right now, and I'm still looking at property in El Salvador. Assuming a Trump GOP sweep, which is one of the assumptions the market is making at this time, there's a lot of discussion about privatizing the GSEs. In your opinion, or anything that you've heard, what would be the impact on the housing market should that occur? Because I honestly think they're beyond repair.
I mean, the person to ask is actually in the audience, Kevin Erdman. Kevin, could we make him a speaker? I'd be interested to hear his thoughts on it.
I shall request it right now because I think that is a fantastic analysis, because I think the financing side of this, we see the sales and everything else, and we have another individual who'd like to ask a question, Kane, but it is a problem, I think, that no one is anticipating. We've had so many things come out of left field. It does present a challenge. Kane, if you want to take a quick stab at the question before we move on to Kevin, hopefully he joins us here.
Hi, can you hear me?
Yep.
Sound fantastic, sir. Go ahead.
Hi, thank you. First question for me to one of these things. So I just want to say, with the recent signs of softening labor markets potentially leading to the Fed to cut interest rates and consequently lower mortgage rates, I'm concerned, as well as everybody else, with the implications for over-leveraged Americans. Do you believe that the stricter mortgage lending regulations implemented after the global financial crisis have sufficiently mitigated the risks that we're seeing right now, ensuring that the current environment won't lead to a similar crisis? How effective have these regulations been in strengthening the lending process and protecting the American consumer? Could it be that we are now seeing the first big test of those regulations? And one quick follow-up, could refinancing help prop up the housing market in this scenario? Thank you very much.
Well, I think on the refinancing bit real quick, one of the concern areas is that, you've had the values of their homes go up so much over the past few years. And, if rates get, too low, could, people be tapping into too much of that equity? Could that have impacts on, the market? And is that something the Fed would like? But in terms of the changes in the mortgage market, there's also the other side of it, where I think you would ask the question, if we have done enough. It's a question of, did we do too much? And, has that been one of the things that helped to get us here over the past 12 years. The fact that, we changed the mortgage lending and cut so many people out of the market during a time when we were going through a housing bust, and that deepened the bust. And if you go back and you look at what happened to single family construction, even if you're somebody who at the time believed that, what happened to the housing in terms of the prices in the mid-2000s had just gone too far, what happened to single-family building was just wild, how far it went down. And, there's a question of, did those mortgage changes and that tightening of lending and the people knocked out of the market, is that something that has helped to get us to where we are today for the market? So I kind of took a different direction with your question.
Lance, do you mind if I add to that and just kind of comment?
Go for it.
Quickly. So, so I think you're right. So what I think a lot of people don't understand as well, it's not just the people that couldn't borrow or get a mortgage. It was also the banks largely left lending, and it went off to the non-banks. And then what happened is we doubled Ginnie Mae, which is FHA and VA, from 2009 to fill the hole in kind of those where the private markets were before in terms of the subprime. So I think it was more of an evolution that, yes, it became very restrictive after, the GFC. But then what happened in actually 2021 is they changed the ability to repay rules very quietly, and they let go of the DTI requirements of 43%. You can't go over 43%. So I think that it has absolutely evolved, that it was restrictive, but that changed. And as the market was actually topping out, I think everybody got a little addicted to the gain on sale that you get from delivering these into the secondary markets. And they just started bringing in as many folks to keep it going. And that's why you're seeing early delinquency in 21, 22, and it is higher than any other vintage year. And you're seeing 23 and 24 ratcheting up very quickly. I'm doing a rate of change analysis. But I think to answer Kane's question is there's a lot of credit quality gospel singing, but things really changed during the pandemic boom. But Lance made a really great point about it was so restrictive at the beginning. I think that's why also we've seen private note sales occur, because people felt like they could not go into the traditional marketplace.
And fantastic. Melody, thank you so much. Kevin is going to join us, Lance, and answer my question, I hope. Kevin, welcome aboard.
Hello. Yes.
Go ahead, sir. You sound fantastic.
So, what's the question you'd like me to address?
Essentially, my question is, what would be the impact on the housing market should the privatization of the GSEs occur? And I mean total divorce from the government, no more crutches. They have to survive on their own as independent corporations.
I think that would be, I suppose it would depend on, there's the QM patch that's been basically the main conduit for any mortgage lending with default risk. So something would need to be changed with that, where there was less pressure on private banks, so that they got back into the lending game in default risk. So I think it could be really bad if it sort of ends up sort of getting rid of the QM patch.
Do you think that the team, we'll just leave it at that, is capable of setting up a phased step down over several years with a QM patch through some sort of government-backed insurance program for all of the banks to substitute for the GSEs, or do you think this would become just an instant nightmare if they just sit there and pulled the plug and said, "Here, good luck"?
Probably my take is probably different enough from what's maybe the take in general on this call that it's almost like speaking a different language. So I'm not sure quite how productive a conversation I could have on it. I don't quite understand the conceptual, how people are thinking about privatizing them. To me, they actually have value as a public entity because it sort of socializes systematic risk in a sort of special way, and so sort of why they're valuable now is because they don't really need to have capital, since they're completely sort of public utilities at this point. So I honestly have a hard time thinking through how we would set them up as private entities that need capital in a way that really is any different from any private bank. So I can't really conceive of a functional way to privatize them.
Kevin, thank you so much. Lance, if you'd like to ask him a question about this, go ahead. Personally speaking, I think it's just easier if J.P. Morgan and Goldman buy both of them.
Yeah, I don't know. I don't have any real deep thoughts on the topic. I'll need to look into it more.
The only reason I threw this out there is because we're in election season and some of the crazy things in the crazy season have occurred. Kevin, thank you so much for answering the call, because it's one of those financialization questions that people don't look into, and there are consequences from elections we've seen it in the last 15 years. I really don't want to think about it, to be honest. Lance, I've taken enough of your time. We've hit that 1 hour mark. We promise to keep our guests on as long as they can stay. Lance, if you'd like to promote your website, your writings, how to subscribe, please go right ahead.
Yeah, so if you want to follow my work, subscribe to my newsletter, go to ResiClubAnalytics.com. As soon as you get there, type in your email, you'll get signed up for the free list. I also have a pro membership, which gets 3 additional articles per week, access to my tracker and stuff. But, you know, the free one, I give out a lot of good content there, lots of charts, lots of good interviews, so no pressure on getting the premium product. And really the premium one is, you know, for trying to get into like more of the market data and kind of see my analysis and more of my interviews. But ResiClubAnalytics.com is where you could go, type in your email, get signed up for the free list. And then the other place that I'm all the time is here on Twitter. I spend way too much time here. I don't want to admit how much time I spend on Twitter. And my handle @NewsLambert. And if you ever have any questions or need help trying to find things, feel free to reach out to me, send me a DM or message me. Always happy to try to help. And the other thing is I just want to, you know, thank a lot of the people on the call, and a lot of the listeners here who also look into housing and write about housing and analyze housing. It's a super important topic. It's one of the, you know, biggest expenses that people will do in their life. It is one of the biggest generators for wealth. Everybody is affected by housing. And so, you know, I just really appreciate that everybody is interested in it and trying to ask questions and dig into it and find out what's going on.
Lance, thank you so much. I'm going to invite Kalani in a minute here because we got to talk about this. Once again, if you're not paying attention, RESI, clubanalytics.com. That is Lance Lambert. Lance, thank you so much for being a guest of the program. You were fantastic. We'll do this again if you get a chance in about a quarter. So we can sit there and review it. As you can tell from the team we have here, we have a lot of people that like to ask, investigate, and discuss housing. And you were just awesome, sir.
Well, thank you for having me, and everybody have a great weekend.
You too, sir. Have a good day. All right, Kalani, welcome aboard. We have a little bit of market to discuss, and I'm going to sit there and open this up for you. Volume was less on the NASDAQ than yesterday, higher on the NYSE, but technically speaking, the damage is only severe through a few gaps. What's your take on this?
Well, first of all, can you hear me?
10 out of 10, sir. Go ahead.
Thank you, sir. Prior to this spaces, while the market was actually still open, I started jotting down a list of concerns as far as equities are concerned. And somehow I got to the number 13. I don't know if that's an omen or what, but I just want to share some observations and concerns that I'm seeing. First, obviously labor, non-farm payrolls came out today. Unemployment rate went up. As all of us in the group know, Don has been kind of pounding the table, watch labor, and it is a big concern and probably will continue to be. The next thing I was looking at was Japan. A couple days ago, they raised interest rates, which kind of, I think, actually was counterproductive. It's probably scared the market more than it did any good for them. Obviously, the last 2 sessions in Japan were pretty horrible. Obviously, the volatility index is concerning. Just today or the last week or so, we've had the largest spike since Silicon Valley Bank. Yields crashing are obviously a concern. It's certainly a recessionary sign. I've been watching commodities for a while, John, as you know, and commodities have actually been leading equities in going down. So that presents an opportunity in the future probably, but I don't think we're quite there yet. Transports, as I said last week, are just absolutely abysmal. AI, really overhyped. Nobody outside of chip stocks like NVIDIA are seeing any return on investment. The semiconductor sector is a bloodbath the last few weeks. Most concerning to me is the speed of decline in semiconductors and the SOX index. Small caps are not holding up like people hoped. A lot of people, I think, in the last few weeks thought they could hide in small caps. I don't think that's that's showing unsuccessful. I don't think we have any real panic. I don't think there's a reason to panic just yet. If we have real panic, then we would have seen the dollar actually go up instead of going down like it did today. And some of the things we were talking about or chatting in the group earlier was obviously watch credit spreads. If they begin to widen, that's obviously really concerning. And crude oil prices, and this is tied in with geopolitical risk, but which is huge right now. But crude oil prices have been really coming down. That could change on a dime depending on what happens in the Middle East. But those are just some thoughts and observations from this past week.
I'm going to throw two things out. First of all, transports, we saw no indication of a growth of the consumer. There's a backup of containers in Long Beach and Los Angeles. My fear, and as I expressed it to Neely, by the way, if everybody didn't hear our interview with Neely Tominga, yeah, we'll name drop here at MacroEdge. We're not shy. The backup of containers is an actual indication that there are companies and retailers gambling or betting on the come, as it's called in Vegas. Don will fill you in on that. That you're going to see a great retail season in the fall and winter. However, if they bet on that and they're wrong, and the transports are telling the tale of the tape, you're going to see a lot of retailers go tango uniform the first of next year. Number two, for the fact that gold got over 2,500 and withdrew right back down again due to a certain company selling a lot of gold contracts, and I can't disclose anything about that, but one company was involved in selling a lot of them, along with selling equities. There is a lot of things under the surface that indicate that there are liquidity problems with some major institutions, and that's why we've seen institutional selling for 3 weeks now, going on 4 next week if this continues. Kalani, you were in a big institution. What does it mean when we say institutional selling and distribution? Kalani, you there?
Can you
go ahead, sir? Oh, he seems to have a bad connection. Well, I'll explain my side. Go ahead, sir. Try again. This is X-Spaces at its best. Elon, you can send spaceships into orbit, but you can't get people to talk to each other through your system. Come on, man. Put some money into it. It could take over radio. We're going to lose AM radio soon anyways. Kalani, let's try it one more time. Nope. We seem to have dropped it. So I'm going to go ahead and wrap the show up. We are talking about a situation where institutional sellers, the insiders, the people who know what's going on, the people who understand how the markets work, are liquidating large equity holdings in large blocks. And when the transports are paralleling those liquidations, it means we're about to have a major recession. Now, Don has been hammering this, Don Johnson, our economist for MacroEdge.net, MacroEdge.net/ozone, get your 2 weeks free. If you follow what's happening, folks, when you have the transports failing like they did today, along with the institutions liquidating, it only means one thing. This recession, with the inversion, is going to be far worse than you think. When the bull steepener kicks in and the 10s passes the 2s, you're going to see a sell-off much worse than today on much higher volume and technically breaking anything any of these kids, pardon my quote, have ever seen. And I'm talking 5, 7, 9% correction in one day. People haven't seen that in a long time except during the pandemic. And they thought, well, the government bailed us out. The government won't be able to bail you out this time. And that's what everybody should be concerned about. So, prepare yourself for a wild 180 days of fun. It's going to be a wild time. Meanwhile, if you want to get the data you need to become a more intelligent investor and trade ahead of the market, go to MacroEdge.net/ozone, sign up for the 2-week free trial, and have at it. For MacroEdge Radio number 17, thanks to Lance Lambert, all the guests, Melody, Mr. Awesome, and everyone else. And I tell you what, this was a fantastic show. I learned a lot. Good night now.